Xero reported operating revenue of 2.75 billion Australian dollars for the year ended March 2026, a 31% jump, and the share price fell 8% on the day. That gap between what the business produced and what capital is willing to price it at is now 55% wide over 12 months. The question that number forces is not whether Xero is growing, it is whether any rate of revenue growth can justify the cost structure it is building to achieve it. The ASX 200 index ended the session under pressure on Friday, with mining stocks dragging the benchmark lower as copper prices fell. BHP Group and Rio Tinto both gave ground. Commonwealth Bank, which lost its position as the ASX's most valuable company earlier this week, slipped further. Against that backdrop, the technology sector had been holding a relative bid, which makes Xero's inability to hold its own result all the more telling. The accounting software company reported net profit after tax of 167 million Australian dollars, down 27% from the prior year. Revenue grew at 31%, profit contracted by more than a quarter. Those two lines, moving in opposite directions at that magnitude in the same financial year, are what reset the market's valuation framework for the stock, not the revenue figure itself. At the time of reporting, Xero shares had already fallen 32% in calendar 2026 before today's result was released. The tension that session did not resolve is whether the profit decline is a one-year investment cost or the beginning of a structural compression. That is now pricing against each other. The mechanism behind the profit contraction is the Melio acquisition and Xero's accelerating push into the United States market. Organic revenue growth, stripping out Melio, came in at 21%, strong by any conventional software standard, but materially below the headline 31%. That difference matters because the capital cost of bridging those 10 percentage points is what ate the profit. Xero's customer base reached 4.92 million, up 11% on FY25. In absolute terms, that is a business adding subscribers at scale. But the cost of acquiring and integrating those customers through the US channel, combined with the Melio platform investment, reversed the profit trajectory at the exact moment the company needed institutional capital to re-rate the stock higher after a brutal 12 months. The pattern has a precedent on the ASX. When Afterpay scaled aggressively into North America between 2019 and 2021, Australian institutional holders accepted margin compression as to justify some addressable market expansion, right up until they did not. The re-rating when it came was not gradual. It was a single change in the discount rate applied to future free cash flow, and it came faster than the revenue line warranted. Xero's 12-month chart, down 55% against revenue growing at 31%, follows that same sequence, capital withdrawing before the fundamentals have turned. What that precedent can't tell you is the threshold at which the US expansion starts returning capital rather than consuming it. Xero has not guided to a specific margin recovery timeline. That absence of a commitment date is precisely what the sell-off is pricing in, not the 27% profit drop, but the open-ended duration of the investment cycle. The unresolved question from Friday's result is whether 21% organic growth, sustained for 2 or 3 reporting periods without further margin deterioration, is sufficient to stabilize the share price, or whether Xero needs to demonstrate Melio-related synergies in actual margin recovery before institutional positioning shifts back. The continuation case rests on a specific condition. If Xero's FY27 result shows organic growth holding above 20%, while NPAT stabilizes or expands even modestly, the current price, already down 55% from its 12-month peak, begins to reflect a bottom. The comparable case here is not Afterpay, which was acquired before it proved the US economics. It is REA Group, which absorbed significant offshore investment costs in the early 2020s before Australian institutional holders returned in size, once the domestic margin base proved durable. The breakdown case is equally specific. If the next result shows organic growth slipping below 18%, the level at which US subscriber acquisition costs no longer scale with revenue, the argument that Melio is an investment rather than a dilution becomes structurally harder to sustain. At that point, the 55% decline would not represent a buying opportunity, it would represent a correct re-rating still in progress. The benchmark to watch before the next result is Xero's US subscriber count in the interim trading update, expected in the September quarter. A second consecutive quarter of sub-10% US customer growth would signal that the acquisition premium is not converting into the market penetration the margin compression was supposed to fund. That number, more than any single analyst price target, is what determines whether the gap between 31% revenue growth and a 55% share price decline is eventually closed or widened. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.